Welcome to our 26th edition of NP Connects. We are moderated today by my good friend and partner, Greg O'Shaughnessy, and I'm Christopher Keefe. We have a fantastic panel today looking at the topic of SPACs and generally speaking, the market and the regulatory issues in considering this very hot aspect of the capital markets. So I will give an introduction to our panel today, and then Greg and I are going to hand off and ask questions. And we also have received a number of questions from our loyal listening audience and viewing audience, and we will get to as many of those as we can. If we don't get to them, we'll try and follow up with you after today's session. So hope everyone out there is doing well. I know we've got a packed house, and we'll get right at it. So we're joined today by John Hoffman, who's a managing director at Credit Suisse in the investment banking division based in New York. John's been a member of Credit Suisse's equity capital markets group since 2012 and is responsible for leading the firm's capital raising efforts in the life sciences sector. John's product focus includes IPOs, SPACs, follow-ons, ATMs, convertible offerings, spin-offs, private placements, and shareholder monetization strategies. So John, thanks for being with us here today. Sumit Mehra is managing director at PTK Acquisition Corp, which is a technology-focused SPAC that's raised $115 million in an IPO in July of this past year. Sumit has over 18 years of experience in technology investing and technology investment banking. During his career, he's been involved in more than $75 billion worth of transactions in the technology industry. And before PTK, he was a managing director at Canyon Bridge, which is a technology-focused PE firm, and prior to that, he was a technology M&A investment banker at Lazard and Morgan Stanley. So, Sumit, thank you for being with us. John McCarthy is a partner at Markham. John has over 17 years of experience providing audit and financial reporting services to public and private companies with a specialty in real estate, including the real estate investment trust product REITs. He's also has industry expertise in the fields of hospitality and not-for-profits. Then we've got a couple of hometown gentlemen. Dick Langen is a longtime partner and friend at Nixon Peabody and a member of our SPAC team. He's got extensive experience in domestic and cross-border corporate transactions, including public and privately negotiated M&A transactions, joint ventures, strategic alliances, capital markets transactions, leveraged buyouts, and other private equity transactions, corporate restructurings, and corporate governance, including engagement with activist investors. And then last but not least, we've got our partner, Michael Smith, with us today. Michael's also a partner and part of our SPAC team. Michael has over 25 years of experience advising international and domestic companies on global capital markets and U.S. securities laws, cross-border M&A with a particular emphasis on Canada and the UK, international fund formation, and Sharia finance. So we are here today to talk about SPACs, and without further ado, I'll hand it off to Greg O'Shaughnessy to ask our first question of John Hoffman.
Excellent. Thanks, Chris. Appreciate it. So John, kicking off with you, maybe let's start with the big picture and just start to get at what's kind of behind this SPAC phenomenon. How have SPACs become such a significant portion of the capital markets in today's environment?
Well, first off, thanks so much, Greg and Chris, for having us today. It's a fun topic to talk about. Frankly, I'm surprised that it took you 25 sessions to get to the SPAC topic and you're 26, just given we kind of live and breathe SPACs all day long, everybody on this phone. So maybe to provide a little bit of perspective on the first question as to how they became such an important part of the capital markets, as we think about it, there's a few different forcing functions along the way, some structural, some market related, some technical in nature. From my view, I think the structural underpinning of what happened a number of years ago, where the vote, the shareholder redemption vote, was decoupled from actually the redemptions that took place, was a really important change in the structure to catalyze the structure to become, I don't know if we're up to version 3 or 4.0, but continuing to iterate on the SPAC structure itself so it was more friendly to the companies that were choosing to pursue that path was a really interesting development within the market. Now, since then, there's been a number of other activities that have also caused the SPAC market to really take shape in a much more formidable way. I think first and foremost, if you think about some of the other areas of the capital markets where we've debated very hot button issues for years now, think of the technology sector, for instance. where we've always talked about day one pops. Are they fair? Are they not fair? The SPAC is a vehicle to try to intermediate that dynamic and somehow course correct what some people think is an IPO tax was one forcing function from a subsector perspective. Within the life sciences space, where I spend a lot of my time, thinking through what came to constitute public market debuts for companies of having a two-step process effectively, a crossover and then your IPO, collapsing those into a single instance where you sped up a company's access to capital in a much more streamlined fashion, allowed managers to focus on operations and running the business as opposed to being perpetually in this cycle of raising capital, a really important development that was offered to them within the SPAC market. A couple of other more macro factors at play as well are clearly behind the SPAC boom that we've seen. If you dial back the clock to last year, there was the end of the year that wasn't, which was the elections. Obviously, everybody thought that market activity would shut down post the elections. That did not happen. But as we talked to companies in call at the June timeframe, very many were asking us the question, what's the fastest way to the capital markets? I have to get my IPO priced by such a date, because if I'm relying on a window of availability in November or December, it may just not be there. The SPAC conversation moved to the forefront of many of our discussions based on the timing advantage that they offer in terms of price discovery and certainty of capital with what I think is probably the most important development in all the things that I mentioned, the institutionalization of the PIPE market. So coupling the PIPEs alongside the SPAC process, which has allowed companies to raise validating capital alongside the SPAC sponsors that have brought really attractive vehicles to them, has been, I think, the most important development within the market, which has caused this to become not only an alternative, but in many instances, a preferred alternative for companies to pursue as they evaluate their capital markets alternatives. I promise I'll be a bit more. I promise I'll be shorter in my answers going forward. That one, I may have.
No worries.
Big question.
Yeah, and point taken on session 26 to get the SPACs. Although to be fair, our first 5 or 10 were based on important topics like where can I find Lysol wipes and a patio heater. So we're getting around to the financial markets as quickly as we can. So no, just kidding. So talk a little about the past couple weeks in particular have been a bit turbulent. What's the sort of the current state of play in the SPAC market?
Yeah, it's interesting because it's one of the areas of the market you can actually talk about SPACs almost as an asset class. You can't really talk about IPOs in that respect. They're very subsector driven. So sometimes IPOs out of the technology sector are working, other times they aren't. But biotech IPOs happen to be working. SPACs, for whatever reason, given the focus of a fairly contained buyer base that have always focused on the product, do behave as an asset class. And I think in the past handful of weeks have seen a little bit of deterioration in conditions based on what has become very well known in the market around the oversupply that we saw, frankly, for the past 3 months in particular, and one could argue for even a longer period of time than that. So with the number of SPACs that are outstanding, I think we're just working our way through a bit of an indigestion issue where there was just frankly too much volume for the market to consume. We've seen these periods of dislocation happen in the past. Different forcing functions have caused us to work our way through those periods of dislocation. We're confident that we'll see that happen again. It's just going to take some time for the market supply to work itself through the system, most notably through some exciting back ends that we're hoping will get announced, which should free up some capital to help recycle into the front ends and create that virtuous circle, which has come so long to really support the SPAC market. But for the time being, we're seeing a bit of indigestion in the market, both on the front end capital raising side, and importantly, that has spilled over into PIPE capital raises, where we're seeing investors become more selective in the assets that they choose, much like they do in an IPO, not owning an asset class, but owning a particular security based on the merits of the equity story and how it fits within their overall portfolio as being the bar that they hold these investments to. Whereas late last year and parts of early this year, it was more of an asset class decision. So some challenges near term, but longer term, very optimistic on the product.
Got it. John, can you talk a little bit about the impact that the growth of the SPAC market has had on the crossover IPO and M&A markets?
I mean, I think at a high level, it's impacted each of those, both from the seller's perspective or the target company's perspective, as well as the main market participants that either fund or acquire out of those different verticals that you talked about. The impact has been profound. If you think about crossover investors, while there are many investors that have crossover dedicated strategies, there's quite a number that don't. The SPAC product, though, has provided and afforded them a vehicle to express a crossover type strategy in the public markets and gain access to companies that they otherwise would never have had an opportunity to gain access to at the life cycle stage at which those companies are in. So really important from a buyer perspective or a crossover investor perspective in that regard. On the IPO side, it really just represents a competitive alternative to a regular way IPO. We'll probably get to this, but many times we're asked the question, which types of companies are the best companies to pursue a SPAC? In our minds, that's not necessarily the right question to ask, because you're always trying to find public market ready companies and then form fitting their path to the public markets vis-a-vis an IPO or a SPAC based on what their particular objectives are. So with respect to what it's done to the IPO process, I think you have just a competitive alternative to optimize around your path to the public markets. And then what I find really interesting, having been an ECM banker for so long, as you talk about the M&A market, I just love the fact that the SPAC is such a structure-friendly vehicle where you can borrow some of the best-in-class M&A tactics that we always talk about around seller earnouts or unrealized value, and how do you more efficiently and more creatively structure a transaction for owners of a business as they pursue a liquidity event, bringing that technology into the capital markets in the context of a capital raise. Very exciting for somebody in my seat. That I think one of the frustrations historically has always been needing to conform to market standards or market norms within a more vanilla playbook on the IPO side. So lots of ways that the SPAC has impacted each of those different processes. I think the really good news is we've become, whether it's Credit Suisse or lawyers and bankers and Nixon Peabody, very astute as to how to construct processes so that you're synergistically exploring lots of these paths at the same time. And you can do so in a very efficient way. So the fact that you can create competitive tension across all these different channels is a highly attractive output of the SPAC phenomenon that we've seen.
Well, it strikes me that you really have, you hit on a couple of important phrases there. One, public markets ready. The mechanism, the SPAC product has really, I think, changed, expanded, democratized, however you want to characterize it, the definition of what's public markets ready, and that has made the pie bigger. So it strikes me that that is really the fundamental advance that the product has created in the market. You hit on one other thing, John, and what you just said, which is this has changed the way that investors can engage with the market. And so talk a little about that, about sort of how that's changed in the SPAC context and how that differs from a traditional IPO.
Yeah, that's a really great question. I think oftentimes when we talk to companies about the SPAC alternative, they'll conflate speed of the product with efficiency and less work. That's actually not the case, particularly on the investor engagement side. The investor engagement that you can do in connection with a SPAC is multifaceted. It's, I think, broader than what you can otherwise achieve in either a crossover or an IPO context because of a few different factors. One, and we talked about the PIPE market being such a critical part of the SPAC, the PIPE price discovery process and investor engagement process is very different than your typical IPO. It's done under the guise of confidentiality. There's less timing, less stringent timing parameter under which you're operating, so you can truly engage with investors in a more bespoke and robust way, as opposed to a regular way IPO, where we advertise a pricing date, have a very short duration IPO roadshow, and cram as many meetings as we possibly can into 3, 4, or 5 days. So I think the sheer fact that you can do things at a bit more of a measured pace in that PIPE discovery process with those investors is a real differentiating characteristic of the SPAC process that's oftentimes underappreciated at the outset of choosing that potential alternative. In terms of other ways in which we see that the investor engagement process is very robust in the SPAC process itself is upon the announcement of the de-SPACing, you're effectively a public company that's announced a transformative event for you. And so utilizing that as a means to help get the word out, build your institutional investor base, rotate any of the SPAC shareholder investors that may not be long-term investors for the vehicle into more fundamental hands represents yet again another very natural time point to engage with the public buy side. And then from there on out, there's a number of other different points within the de-SPACing process that provide natural points to engage with investors, such as an analyst day, right? There's different ways in which you can engage with both analysts and investors, and crescendoing the kind of the investor engagement build that you have post announcement around those events is a real distinction compared to your typical IPO, where again, you're conforming to very kind of rigid playbooks or rigid parameters that have just come to characterize that end of the market.
John, if you're a company who's considering, these alternatives, a SPAC, an IPO, M&A, traditional M&A, and you're thinking about the SPAC, that path, how do you think about what kinds of companies SPAC sponsors are looking for?
Yeah, it's again a good question that's hard to answer with a great deal of precision, but maybe taking a higher level approach. We touched on some of the points. So from the macro, ensuring that you're public company ready, obviously something that's critically important. Secondly, as you think about what is working for SPAC sponsors, when there's a clear alignment of vision between what the SPAC sponsor set out to raise their capital for, when they pitched investors on the utility of the product, and ensuring that that aligns with the company's positioning, clearly something that a SPAC sponsor is being held up against their scorecard against with the investors that they raise capital from. So I think really critical to make sure that there's an alignment of vision, alignment of equity story narrative, and what was told to those SPAC buyers when they funded that particular sponsor as they pursue their back-end candidates. Now, from maybe a more micro level perspective, a few different situations, or maybe not specific situations, but attributes where we saw a SPAC sponsor really seeing an opportunity for particular companies. One, there's very many companies where I think you can make the case that access to substantial capital, whether that helps accelerate sales and marketing, accelerate R&D, further differentiate the competitive profile, the sheer fact that the SPAC lends itself well to larger capital raises compared to alternative products. If you can make that case, I think that you're, in the eyes of a SPAC sponsor, somebody that would be a very credible target and have a very credible narrative as to why the SPAC was the path pursued. Secondly, we talked about the fact that the SPAC affords companies a faster path to the capital markets, or at least to PIPE capital certainty. I think if there is a thematic trend in the market that, for whatever reason, is on point, based on a public comp that may have achieved something, or an IPO that worked in a very pronounced way, the SPAC process from a fast follower perspective also works exceptionally well. Similarly, from a competitive differentiation point, if there is a rationale to get to the public markets as quickly as possible, I think that also is a concept that resonates with a SPAC sponsor as to why that vehicle worked very well. And then lastly, we touched on this before, flexibility of the structure. In my world, life sciences predominantly, you oftentimes see very many management teams think about their assets being mispriced because investors will only give you credit for a program or two that you're working on. The fact that a SPAC sponsor can offer to a target company unrealized value that they can earn back over time with things like seller earnouts, if that's a concept that resonates, I think that's also something that a SPAC sponsor would find very attractive about a target company.
And then, John, insofar as it takes two to tango, running it back the other way, how should a company, a potential target company, evaluate a SPAC sponsor?
Yeah, it's a really comprehensive framework. I mean, a number of different things that you can evaluate a SPAC sponsor on. One, obviously, track record. We've seen the market evolve into one where there's a number of serial sponsors that have a proven ability to execute de-SPAC transactions. So having an appreciation for what they've achieved in the past and how that lines up with what they've set out to do with your particular company, I think critically important. If that's not available, then just having an understanding of public market track record or what the resume of the SPAC sponsor suggests they should be focusing their efforts on, I think is critically important. Things such as size of the ultimate SPAC, obviously something that needs to work from a use of proceeds perspective. Doing your typical SPAC math to make sure that things like the promote amortized against the asset base also mathematically makes sense for PIPE investors. The amount of capital that the SPAC can bring to the table outside of the trust, so things like a forward purchase agreement or PIPE investor relationships that they have, again, all critically important to evaluating different SPAC sponsors. Now, the one thing that we often talk to companies about that very frequently is at the top of their list, but not often at the top of ours, is the concept of valuation. So, oftentimes you'll hear a highest bidder should win, and that's not necessarily the case given the redemption feature that exists with the capital and trust. So we oftentimes advise Valuation is obviously critically important, but this is more of a partnership transaction, not an M&A sale, where the view is sometimes one party wins at the expense of the other. The PIPE market has to still clear the transaction, and the market still needs to accept it to curtail what would otherwise be high redemptions if a too highly valued transaction came to the market. So again, value important, but more around framework and alignment of vision than it is the specific number in our view.
Thank you, John. But why don't we sort of shift over, Sumeet, to you and get your perspective on some of these issues, and maybe John spent a little bit of time talking about this, but be great to get your perspective on the advantages of a SPAC relative to other routes for going public, whether it's traditional IPO or a direct listing, et cetera.
Yeah, first of all, thanks for having me, Greg and Chris, and no, exciting times for the SPAC market. And I think John may have already stolen some of my thunder, but I think some of these points are worth repeating. Look, we are in one of the most amazing times for companies looking to go public. There are 3 viable options, more than the companies have had in the past. Of course, traditional IPO, which has been around for a while, direct listing, and now SPACs. Technically SPACs are not an IPO since it's really a merger with a company that's already IPO'd earlier. But for purposes of this discussion, the end result is the same, so we can think of it as an IPO. Each has its pros and cons. The bar for a traditional IPO is typically been higher. In terms of the maturity of the company, in terms of the scale of the company. For example, pre-revenue companies outside of healthcare and biotech typically find it harder to go public, where the traditional route disclosure requirements are quite significant. And John talked about some of this. The roadshow is pretty truncated. The companies are not at the freedom to talk about forward-looking projections, etc. So if it's a complicated story to tell the market, it's just harder to do it in the context of a traditional IPO. Direct listings make a lot of sense. We saw a big one yesterday, certainly in Coinbase, but it makes sense for companies that don't need to raise additional capital, although that might change. And if they have a well-established brand, maybe a direct listing is certainly a viable route. But I think SPACs occupy an important niche of their own with very clear advantages. It's relatively faster process. You can go from starting a SPAC process to closing the deal in 4 to 6 months, as opposed to a traditional IPO, which can go on for a year perhaps, and less distraction for the management team, more valuation certainty. And I think this is a really important one, since valuation is really a negotiation in the context of a SPAC between the sponsors and the target, as opposed to a traditional IPO, where sort of you get priced on a particular date, and a lot of conditions can come into play depending on the state of the market, etc., and how the book's looking, and so on. And then complicated stories can be told more easily. I just want to sort of hop on how important this point is in the context of a SPAC. With the PIPE investors, it's a 4, often longer than that, but at least a 4-week diligence process, where they have a lot more access to the management, a lot more access to information, and can really get in deep and understand the story from the management on how what the vision of the management team is and how they plan to execute on it. So they can have relatively deep conversations with the buy side. For certain kinds of companies, this is critically important. So if you are a company has a long gestation period, think about clean tech or auto tech or EVs and autonomous vehicles, where there is a significant investment period for the first 3 to 4 years from the time of the de-SPAC, and then there are significant revenues beyond. That kind of story is really hard to tell in the context of a traditional IPO. It's much easily told in a face-to-face meeting or multiple sessions in a diligence with the PIPE investors, and then providing some forward outlook, which is typically not possible in a traditional IPO. So in terms of getting a better valuation and a better appreciation for what this company could become in the future, that kind of story is much easier told in the context of a SPAC as opposed to a IPO. And then one-offs, like we saw this last year, companies talking about one-off impact from COVID, etc., on their pipeline. on their projections or on their current financials, which may not be again possible in a traditional IPO. And then I think the pipe part is an important part because, you know, now with the institutionalization of the pipe market, companies are not limited to just the size of the SPAC, so they can raise significantly larger amounts of capital through the pipe process, which is non-dilutive since the pipe investors come in at $10. So it's a pretty attractive way now to raise quite large amounts of capital. Then I would also point out that sort of management teams maintaining control. So, you know, unlike other transactions, management teams typically stay in control, as opposed to, in this case, I'm comparing a SPAC to, say, a private financing round. So instead of going back to through a series of private rounds over a series of, you know, Series B, C, and D, et cetera, we are seeing some companies come to the SPAC market and raise large amounts of capital, which will take them to cash flow break even between de-SPAC and, you know, the next 3 or 4 years, which helps them then focus on the business as opposed to trying to raise capital every year and, you know, taking away from the time they would have spent building the business. So I think it makes a lot of sense for those kinds of companies as well. And then I would say on the buy side as well, right? Both institutional and retail. This is the opportunity to buy into some very exciting opportunities relatively early when the growth is still ahead. You know, you've seen some big IPOs lately, but a lot of the growth is already priced in. When you're buying in an IPO at a $100 billion valuation, a lot of that growth is already priced in, and you're coming in, you know, and a lot of the value creation is already being captured by the venture funds that invested in when the company was private. But by participating in the pipe market, you actually get to participate in and potentially get in on the ground floor of what could be a very disruptive company in the future. So I think in some sense, you know, SPACs have sort of democratized the IPO process and allowed a whole class of investors, both institutional and certainly retail, to participate in some very exciting, you know, transformative companies of the future at a pretty early stage in their life cycle.
I'm interested. Let's turn to the team for a moment. You've got significant experience with that. Sort of what makes a successful SPAC team?
Look, I'm not sure if there's any defined formula for success as a SPAC team, but I do have a few thoughts on this. I think the quality of the sponsors, which John was referring to, matters first and foremost. What is the domain or sector expertise of the sponsors? You know, SPAC teams that specialize in a few themes, be it a sector such as tech or healthcare or health tech, or a certain geography such as you know, US or LATAM or Asia, or a thematic driven investment strategy such as, you know, climate change or sustainability or auto tech. You know, that makes a lot of sense to me. So, and then you have to look at the sort of the track record of the team and their expertise in that industry, both in an operational capacity. Perhaps they were working as part of senior management teams in companies in that space, or have investing and M&A deal making experience in that sector. So ultimately, SPAC sponsors have to show that they have proprietary deal flow and relationships within that area of focus that will help them stand out relative to their peers when they go raise that capital in the IPO. So that matters. And then I think the strategy of the team, which is typically disclosed in the S1, is critically important. This differentiation, I think, is also important for from the point of view of the SPAC target, because look, ultimately they're looking for value add beyond the capital that's available in the SPAC. You know, a dollar from one SPAC is the same as a dollar on the SPAC's trust. So the differentiation really comes down to what the SPAC sponsor brings to the table beyond that. So, you know, that could be in the context of pipe relationships, certainty of execution, and then at the board level, typically SPAC sponsors will take on 1 to 2 board seats at the target post-closing. So what value add do they bring in terms of industry relationships or making connections with potential customers and so on and so forth. So what I've seen is that successful teams typically have a mix of sort of operating experience in that industry or the strategy they're pursuing, and also sort of deal making / capital markets and M&A experience.
Thanks, Amit. We just talked to John about, you know, sort of broadly what SPAC sponsors are looking for, target companies. But as someone who's in market, what are you looking for in SPAC targets?
Yeah, no, good question. We look at a lot of companies. Look, each sponsor has their own criteria. You know, we typically evaluate companies along sort of three broad dimensions. The first one is investment rationale. This is no different from how a private equity fund or a venture fund would look at a company, right? So since we are focused on tech, we are first and foremost looking at the company's underlying business. You know, does the company have a demonstrably successful business model? What do the projections look like? What does the margin profile look like? You know, what kind of TAM or total addressable market is the company addressing? Is it participating in a potentially disruptive opportunity? What are the growth prospects? And you know, since we are tech investors, you know, growth is critically important to us. We also tend to focus in deep tech at our SPAC. So we look at company's technology and is it differentiated? Where is the company in its evolution? What are the proof points of success, milestones it has achieved, et cetera, especially if it's a pre-revenue company. Then the quality of the management team. You know, the SPAC transactions are typically non-controlled transactions. So, you know, we are not looking to change the strategy of the company. We are sort of providing the rocket fuel, and you know, the management team is going to run the company. So what is the quality of the management team? What's their vision, et cetera? And can they take this company forward? So that's sort of one bucket that we evaluate the company on. The second one is around public readiness. This was talked about earlier too. This is critically important. You know, just because a company can SPAC doesn't mean it should SPAC. And is the company ready to be a public company? So the maturity of the management team, ability to do quarterly filings, remaining compliant, talking to sell-side research, it's not easy. And you know, it comes with a fair amount of it requires a fair amount of work at and in investment that's required in building the financial controls and things like that. So you know, we'll also look for PCAOB compliant audits. So sort of I put all of that in the big bucket of, you know, is the company ready to be a public company? And that's a pretty high bar and shouldn't be overlooked. And finally, I would say, you know, public market perception in trading. You know, so we think about things like, you know, how will the company trade? You know, can it be attractively priced relative to other comparable companies in the market that the investors are going to look at? So you have to put sort of all of those together to find a winning target.
I mean, there's been a surge in interest in crypto lately. Do you expect to see more crypto companies come to market via the SPAC option?
Yeah, look, yeah, there's the Coinbase craze taking over the markets. Look, I absolutely, I think I'm generally very bullish on the crypto market, and I believe it'll, you know, in the future usher in innovation of the order of what we saw with the internet. So we've already seen some crypto companies access the public markets via SPACs. You know, the Bakkt exchange earlier this year, Cypher Mining a few weeks back. There's an exchange called DigiNex that went public last year through a SPAC. So I think many more will come to market. I think the main point over here is that the crypto is an emerging asset class and institutional adoption is growing. So family offices and institutions are looking for easier ways to get exposure to this asset. And instead of directly having to purchase the underlying asset, which, you know, their charters may or may not allow. So more and more equity vehicles that allow investors to participate in this market, and those vehicles have been fairly limited so far. You know, there are a few Bitcoin trusts out there, and there are sort of equity plays like MicroStrategy, et cetera. But I think crypto companies with real business models, I think we'll see a lot more of those access to the SPAC market. I'm pretty excited about that.
You mentioned access, investor access, democratization. I'm sure a lot of folks on this call today are thinking about, you know, not only how do I get into crypto, but how do I get access to the SPAC market, given all the growth there? How would you answer that question of how do investors participate?
You know, this is best answered by a financial advisor, and this is not meant to be financial advice. But look, I think what's interesting about the SPAC market is there are so many ways to participate during the life cycle of a SPAC. So right from the upstream, right? You can participate as a sponsor, and we've seen some family offices and high net worth individuals participate as a sponsor by contributing to the risk capital. That's essentially you're taking on a higher amount of risk for potentially a higher reward down the road. Then another alternate route is to buy into the IPO of the SPAC. If you believe in the vision of the sponsor team and what they're looking to do, although this is a market that's typically hedge funds participate in, so it's less retail focused. And then once the IPO has taken place and the SPAC is trading, you can buy into the SPAC units in the public market or buy the stock or warrant after they're separated. What's interesting is there's so many ways to sort of participate in a SPAC opportunity and two different kinds of instruments, or three actually, units, stocks, or warrants. And then alternately, you can wait for the deal announcement. I think that sort of reduces the risk a lot. You want to see what the deal that the sponsors are doing, what it is, or evaluate the SPAC target on its own merits, and then decide if there's something you want to buy in. So, unlike a traditional IPO, there's many ways to sort of participate across the life cycle of a SPAC, depending on sort of your risk appetite and what you're looking to do.
Sumit, thank you. We're going to pivot to John. John, SPACs aren't revenue generating companies, and they're essentially shells. They're formed with the specific purpose of going public and then making an acquisition. So why is the role of the auditor important in the context of a SPAC? Or do you just sort of get in and say nailed it and we move on?
Well, first of all, thank you very much to both of you, Greg and Chris, for having me on the panel. So it comes down, I guess, to answer your question, it comes down to anything else. You want to, if you're a SPAC, you want to look to a firm that has experience in this area. So, okay, yes, there's not, if you look at the financial statements of a SPAC, it's in such an early stage, there's not at all very much audit. But as everybody on this call probably knows, there's a lot of pressure that is put on auditors and other parties, but also auditors, to finish up these audits, because we're often kind of the tail that wags the dog, in a little bit, to get these filings done. We're often the last party that needs to approve. So speed is so important with these audits. And yes, there's not a lot to audit, and that enables things to go a little bit faster. But still, the amount of pressure that we get to get these done, because the SPAC wants to get on file. Maybe it's because they see something in the market that they think is a good opportunity and they want to get the ball rolling right away. That's so important. And I would also say this too, the financial statements within the registration statement that a SPAC must file, called the Form S-1, while that's not too much of a heavy lift, the rest of the document, there is quite a bit of information, and there is a lot of tables in there and a lot of numeric tables. And those things take a lot of time to look at, because all deal terms are a little bit the same. So you really need to go with a firm to do the audit that has done these before. And we do so many, and there's other firms that do so many too. Firms that only do a couple, you're just not going to get the results you probably want, because of how important it is to get these audits done. So because we're just that last person, when I don't think the audit firm is always thought of as a key element of the entire working group of a SPAC, because we're often the last element to a SPAC getting on file with the SEC. It is very important, and that's why you want to make the choice of a firm that has done so many of these before and can do it in a pretty efficient way.
Yeah, thanks, John. Well, just from the perspective of an auditor, what would you say the normal life cycle is of a SPAC from its inception to de-SPACing?
So what basically happens in the life cycle is that once we are brought on, and sometimes that's early in the process, sometimes that's shortly before they want to make their initial filing with the SEC. So we'll perform the audit, and once that's done, they'll be able to make their initial filing. And sometimes that filing it depends on the company. It can be a very rough filing with some things that certainly need to be filled in, some holes, because maybe they haven't hired all the parties they need. Maybe there's still some deal terms that are still up in the air. But you know, so it depends on kind of how much that first filing is full or not. If there's some things that are still open about it, then that leads itself to more comments from the SEC. So after that initial filing is made, usually then it takes about 30 days, and the SEC is so inundated right now with these filings that they are taking 30 days normally to come back and maybe give comments to the company. And if the document is in very good shape, the Form S1, the registration statement, then there may not be any comments. But then usually there is another amendment that'll take place in response to comments. And then once the SEC gives the all clear, then it comes to a point where the audit firm has to deliver what's called a comfort letter. And this is something that's required by the attorneys and the underwriter, where we need to provide certain levels of comfort over numbers that appear within the Form S1, within the registration statement. That doesn't take too long. It's not, it's a pretty standard process. Once that's done, and then there's a roadshow, then the SPAC can be deemed an effective company. And they are now, once that public offering takes place, they are now a public company. From there, there's one final audit that needs to take place. It's a balance sheet only audit, but it's looking at basically the money coming in via the offering. It's what's called an 8K audit. And then from there, now the company is a public company. They, until a de-SPAC transaction occurs, they have to file quarterly financial statements, which are called Form 10Qs, and then an annual audited statement, which is called a Form 10K. And those are things that the audit firm needs to get involved in. That continues until the de-SPAC transaction occurs, which is the acquisition that the SPAC will make of an operating company, which is obviously the whole goal in this process. And then that often means the end of the SPAC. So that's, in a nutshell, kind of the life cycle. So there are, certain points along the way, and there are several filings with the SEC that must take place. And then ultimately, the SPAC will be deemed a public entity. And then it is just like any other public entity. It has to do quarterly reports in 10Qs and annual reports on what's called a Form 10K.
John, there was lots of news last week in the SPAC space, particularly around how the SEC views SPACs should be accounting for its warrants and generally sort of approaching their obligations vis-a-vis securities law compliance. Could you explain the role of the warrants in a SPAC transaction and give us your perspective on the SEC's position with respect to warrant accounting?
If I had a crystal ball, I knew that question was going to be asked, because I've been asked it 2, 3, 30, 31 times over the past week. That's
right, yeah, I can imagine.
That's certainly, yeah, I think I've now exceeded the number of webinars that yeah, it's been a huge topic, as you can imagine. And this is from SPACs that haven't even done their initial filing, or more to the point, ones that are kind of far along the process, because those are the ones that may now have to go back and have certain filings that they've made restated, which is certainly a timely process. So in a nutshell, the concept of a warrant, which is a security that offers the holder the right to buy the right to buy or sell a security in the future, that's essentially a warrant. That is a huge part of a SPAC deal, and and the deal has both public and private warrants, without getting too much into the specifics. What has happened is that for years now, those warrants have been accounted for by SPACs as equity. And there's a lot of generally accepted accounting principles that govern whether a warrant should be classified as equity or should be classified as a liability. For so long now, they have been classified as equity. Nobody said anything. All of a sudden now, and this started a couple of weeks ago, and then just the momentum got more and more. And now it's to the point where, because of two elements that appear in just about, not everyone, but almost all warrant provisions. One is to do with alternative issuance of the warrant, and the other is to do with a cash tender provision, without getting too much into the details. Almost all warrant agreements have one, usually both of those, and the SEC is now saying that under U.S. generally accepted accounting principles, which is the financial reporting framework that SPACs have to follow, just like any other public companies, that those warrants are more akin to being liabilities. And because of that, that has just thrown the entire industry for a loop right now. And filings have had to slow down. And the issue is not done yet. There's still lawyers and accountants that are trying to get an understanding from the SEC over exactly what it is within those provisions that is of an issue. So what's going on right now is most CPA firms are not allowing any filings right now by SPACs if those warrants are being treated as equity, because they know that that's just not what the SEC wants to see. So it's an issue right now. It's evolving. I don't know exactly where it's going to go. And because of that, filings, like I said, have slowed down a little bit this week, but it is a big issue that has appeared all of a sudden that all SPACs are going to have to get over that hurdle.
Thanks, John. Before we turn to Dick and Michael, could you just touch on briefly the how much does independence play in an auditor's relationship with a SPAC?
Yeah, well, a SPAC, like I said, like Samit said, like John said, it's a public company. And because of that, if you're the auditor of a public company, you need to be very careful about how much work you're doing that is not truly audit work. What you're really just supposed to be doing is the pure audit work. And that's why SPACs have consultants, accounting consultants, and there's many of them out there right now that are working with the SPACs. Those are the parties that the SPAC can go to for consultation on certain matters, for accounting related questions. Now, it's not to say that as an auditor, we can't help a public company in the way of providing them with the authoritative guidance, which I have certainly done a lot of this week with the warrant issue. But for me to make a decision for them or to help make a decision for them, something very frowned upon in this world, because the SEC wants the audit firm to be the auditor, not the one helping the public company do what they need to do to get the financial statements done and to get the filings made. They want the auditor to be the auditor. And this isn't just something that is relevant to SPACs. All public companies have to do this. And independence can be a very, very hot topic in the public company world, including SPACs. And that's why just about every SPAC that I work with has a consultant, often another CPA firm that knows the ropes of SPACs, knows the Form S-1s, and they're able to be assistance to the SPAC, assistance that the auditor really is prohibited to provide.
John, thanks. That's terrific insight. Sort of keeping on that theme of sort of what's going on in the market, we'll turn to Dick and to Michael now, just to give us a brief update about key hot topics that participants in the market are facing.
Well, thanks, Chris, and it's been great to hear John, Sumit, and John discuss what they've been doing recently in this area and what they view to be the hot topics. So thank you for those presentations. My name is Dick Langen, and I'm here with Michael Smith as representatives of our dedicated SPAC team. Our SPAC team is quite comprehensive. As you would expect, it covers securities law, corporate governance law, M&A matters, and that includes lawyers not only that specialize on the transactions themselves, but subject matter experts from other areas such as labor and employment, employee and executive benefits, environmental, and the like. We also have found in the course of the SPAC transactions that we've needed to bring in a number of regulatory experts, as you might expect on the de-SPAC deals. We're involved with our antitrust lawyers, but we've also had to bring in lawyers involved with CFIUS and defense and sanctions related experts who cover matters like ITAR, OFAC, and CFIUS. We also, as you might expect, to address sector needs. And so as a result of that, we find ourselves bringing in lawyers from our life sciences team, our TMT team, our financial services, including fintech team, and our food, beverage, and agricultural team, as well as our alcoholic beverage and cannabis teams. All of those we have found have helped us bring the best forces within our firm to provide solutions for our clients as they move forward. We're active with SPAC engagements. Well, not only are we involved with sponsors and parties that are considering sponsorships in the SPAC area, but we've also been working with a number of de-SPAC targets, and they in particular have been considering whether or not they would pursue an IPO or use the SPAC as part of a crossover initiative as we move forward. A lot of the work with them pertains to determining whether or not they are ready to be a public company, and if they're not, helping shore them up on a legal front and to bring in experts from other quarters, in particular from public accounting, to get them ready for that move. We've also found that boards and board members have required some advice in conjunction with SPACs, particularly as the regulatory scrutiny of the SPAC transactions has built up. To give you a better idea as to some of the problems that we're working on currently, I'm going to turn it over to Michael Smith for him to talk to you about some of the hot topics. Thank you.
Thanks, Dick. Hi, everyone. So I'll be very brief, but some of the things that we're seeing that we want to draw to your attention are the formulation of pro forma financial statements and what constitute reasonable assumptions under those pro forma financial statements. As John and John had mentioned previously, one of the nice things about a SPAC, especially in the tech industry, is it allows a tech company to, if you will, collapse a process. Instead of doing a crossover round and then an IPO, it collapses that process into one transaction with PIPE investor and with the reverse merger. One of the reasons the investors like that, one of the reasons the tech company likes that, is because the SEC requires you to prepare a Form S-4, because that merger is technically a reverse merger and it has to be filed and reviewed with the SEC by way of Form S-4. S-4 technically requires you to prepare pro forma financial statements. In typical private placement, you don't get to prepare pro forma financial statements. So in a way, PIPE investors get to look at this company the way it's going to be in the next year or two. But we do know there is a tension, and the SEC is watching this, on what constitutes reasonable assumptions. The SEC has encouraged forward-looking information in pro formas. They generally eschew that in connection with IPOs. So we're watching that very closely. One of the other things we're watching very closely, and we know this is a real pressure point right now in the pipeline, is the cost of D&O insurance. D&O insurance composes part of, if you will, the at-risk capital. Generally what the sponsor could lose if he doesn't do a successful merger. And D&O insurance is very expensive because there aren't a lot of qualified board members to sit on all these public companies. There aren't a lot of insurers in the D&O space. They can't handle the volume. And D&O insurance generally isn't received by way of reinsurance. So not a deep market for it. So D&O insurance, we're finding, is becoming a real constricting point for a lot of SPACs that are in the pipeline. One of the other things we wanted to bring your attention to is just the heightened scrutiny the SEC has on the demerger process and the conflicts that may exist. We think this is going to generate more and more independent valuations, more and more fairness opinions, and in particular, if you're a board member of SPAC, being far more conscious of your fiduciary obligations as you navigate all of the conflicts that could exist in one of these mergers. Two more things, and then I'll be done. One, CFIUS, as Dick has already mentioned, CFIUS could catch your PIPE investment. And everyone I'm sure knows, CFIUS, you have to do that analysis depending on what industry you're in, if it's a takeover, if there's a merger, if there's a change of control. But rules recently in CFIUS have expanded that. So it's any investment from certain quarters in a either critical infrastructure, critically sensitive company. And biotech happens to be one of those enumerated industries, but it's much broader than that. So you could have a PIPE investor from, say Europe, and if they're not from the UK or Canada or Australia, you may have a CFIUS issue, and that could screw up your timing. And timing is everything on these deals. So the last thing is what we'd like to say is we're seeing a lot of foreign companies, private companies, thinking of coming to U.S. exchanges by way of merging with SPACs on U.S. exchanges. Because it's a wonderful opportunity for foreign companies to go public in the U.S. with sponsorship on a U.S. exchange. They're not stranded on an exchange. They actually have aftermarket trading in their stock because they're working with a sponsor that's connected to Wall Street. So those are some of the highlights we'd just like to flag for the group here.
Terrific, Michael. Well, John, Samit, Dick, and Michael, thank you so much for the insight today. Remarkably enough, we're coming to the top of the hour, so I think at this point I will hand it off to Greg for some closing comments. But we know we've got a laundry list of questions, and we'll work through some of those and get back to the folks individually who asked them. So for my part, thanks again, and Greg, take it away.
Yeah, thanks, Chris, and thanks all of you panelists. You were amazing, and we appreciate all of your insight. It was great to be able to spend the hour with you. So for all the participants, in addition to this webinar series, I think many of you know we're regularly holding a variety of programs on various topics of interest. To that end, next Wednesday on April 21st, we have our next edition in a series of short 20-minute webinars that are great if you don't have an hour to carve out of your schedule. And on this panel, we'll be talking about what's new in emerging company capital raising, in addition to the SPAC market. You can access all these recordings, past webinars, and all of our industry-specific alerts and other content on our website on nixonpeabody.com. And you can also subscribe to various mailing lists there as well. So again, thanks to all of our panelists for a great session, and thanks to all the participants who joined us today.